Stock market trading, Level 1. Technical analysis for professional traders. Introduction to technical analysis. There are basically two methods used to analyze securities and make investment decisions. These are fundamental analysis and technical analysis. Fundamental analysis involves analyzing a company's financial statements to determine the fair value of the business, while technical analysis assumes that a security's price already reflects all publicly available information and instead focuses on the statistical analysis of price movements. This lesson focuses on technical analysis. Technical analysis may appear complicated on the surface, but it boils down to an analysis of supply and demand in the market to determine where the price trend is headed. In other words, technical analysis attempts to understand the market sentiment behind price trends, rather than analyzing a security's fundamental attributes. If you understand the benefits and limitations of technical analysis, it can give you a new set of tools or skills that will enable you to be a better trader or investor over the long term. Let's go into what technical analysis is all about. Principally, technical analysis is the study of price movements in a stock or other asset in order to identify price trends. Technical analysis is a method of analyzing and evaluating markets and securities by statistically examining charts, showing, for example, past price action and volume. Technical analysts do not attempt to measure a security's intrinsic value, but rather use charts and other tools to identify patterns that can be used as a basis for investment decisions. Technical analysis can help a trader analyze the market, understand the market, develop trading ideas. There are many different forms of technical analysis. Some rely on chart patterns, others use technical indicators and oscillators, and most use a combination of techniques. In any case, technical analysts' exclusive use of historical price and volume data is what separates them from their fundamental counterparts. Unlike fundamental analysts, technical analysts don't concern themselves with a stock's valuation. The only thing that matters are past trading data and what information the future might provide about future price movements. It should be noted that technical analysis is based on three assumptions, which are the market discounts everything, price moves in trends, and history tends to repeat itself. The market discounts everything. Many experts criticize technical analysis because it only considers price movements and ignores fundamental factors. The counterargument is based on the efficient market hypothesis, which states that a stock's price already reflects everything that has or could affect a company, including fundamental factors. Technical analysts believe that everything from a company's fundamentals to broad market factors to market psychology are already priced into the stock. This removes the need to consider the factors separately before making an investment decision. The only thing remaining is the analysis of price movements, which technical analysts view as the product of supply and demand for a particular stock in the market. Price moves in trends. Technical analysts believe that prices move in short, medium, and long-term trends. In other words, a stock price is more likely to continue a past trend than move erratically. Most technical trading strategies are based on this assumption. History tends to repeat itself. Technical analysts believe that history tends to repeat itself. The repetitive nature of price movements is often attributed to market psychology, which tends to be very predictable based on emotions like fear or excitement. Technical analysts use chart patterns to analyze these emotions and subsequent market movements to understand trends. While many forms of technical analysis have been used for more than 100 years, they are still believed to be relevant because they illustrate patterns in price movements that often repeat themselves. Note, technical analysis can be used on any security with historical trading data, which includes stocks, futures, commodities, fixed income, currencies, and other securities. However, for the sake of this lesson, we'll focus on stocks. Support and resistance. The concepts of support and resistance are undoubtedly two of the most highly discussed attributes of technical analysis. Part of analyzing chart patterns, these terms are used by traders to refer to price levels on charts that tend to act as barriers, preventing the price of an asset from getting pushed in a certain direction. At first, the explanation and idea behind identifying these levels seems easy. But as you'll find out, support and resistance can come in various forms, and it is much more difficult to master than it first appears. Resistance level. A price level which a stock has previously had difficulty rising above. At this point, seller strength prevents the price from going higher. The more often the stock tests the resistance line, the stronger the resistance line. The longer the stock tests the resistance line, the stronger the resistance line. Upward price action will typically approach the resistance level, and then retrace to a lower level before retesting the resistance level again. In the case of a range-bound market, price may trade down to a near-term support level at a lower end of the range, before attempting again to break through the resistance level. The more times that the market attempts to unsuccessfully break through the resistance level, and the greater the amount of time between attempts, the more formidable the resistance level. Reasons for resistance. Buyers who bought the share at a low price closing their positions. A share approaching a previously visited high will attract short sellers looking for a technical entry point. Disappointed buyers who are below their entry point and are waiting for the share to return to the entry point in order to exit without a loss. The overwhelming supply that creates a resistance level may be the result of a large institutional investor liquidating a very large position in a stock at a particular price. Until that large sell order is absorbed by the market, the price will remain at the particular level of the order, creating a resistance level. Another underlying cause of resistance levels is the use of popular technical price patterns. When enough market participants react to the sell trigger points of widely used technical price patterns, resistance levels may be created. Support level. A price level which a stock has previously had difficulty falling below. At this point, buyer strength prevents the price from going lower. The more often the stock tests the support line, the stronger the support line. The longer the stock tests the support line, the stronger the support line. Support or support level refers to the price level below which historically a stock has had difficulty falling. It is the level at which buyers tend to enter the stock. If the price of a stock falls toward a support level, it is a test for the stock. The support is either confirmed or eradicated. Confirmation occurs as buyers move into the stock, causing it to rise. If the price moves past the support level, it means the support level failed and the market is looking for a new level. Support is a threshold or price point along this channel below which a stock price does not want to fall. Think of it as a floor. The floor is a sticky place for prices. From an auction perspective, this is a place where many buyers and sellers converge. Buyers and sellers know that when a stock hits a certain price, it brings in more volume. If it brings in more buyers, the price bounces off the floor, confirming the support level. However, if it brings in more sellers, or if buyers fail to show up, the prices fall below the floor or support level. When this happens, the support level can turn into a new resistance level or ceiling. Reasons for support. Short sellers who sold the share at a high price closing their positions. A share approaching a previously visited low will attract buyers looking for a cheap entry point. Disappointed short sellers who are above their entry and are waiting for the share to return to the entry point in order to exit without a loss. For example, assume ABC stock has attempted to fall below an ascending trend line several times over the past few months. But although the price approaches this line several times, it fails to move below it. In this case, the trend line is known as a support level, because it corresponds to a price level where most investors feel comfortable buying the asset, preventing the market from sending prices drastically lower. On the other hand, traders use resistance to describe when the price of an asset has difficulty moving above a given price level, which then forces the price of the asset to decline. Support and resistance. Role reversal. Many traders who use technical analysis often hear phrases that suggest a broken support level will become a future area of resistance, or that a previous level of resistance will become a support. For beginner traders, phrases like this sound like they're spoken in another language, and even many experienced traders never fully understand or appreciate this intriguing role reversal. This article will attempt to shed light on the importance of support and resistance and illustrate why traders should take note when they reverse roles. Remember, support and resistance are terms used by technical traders to refer to specific price levels that have historically prevented traders from pushing the price of an underlying asset in a certain direction. One of the most interesting phenomena regarding support and resistance occurs when the price of the underlying asset is finally able to break out and go beyond an identified support or resistance level. When this happens, it's not uncommon to see a previous level of support change its role and become a new area of short-term resistance. As you can see from this chart, the dotted line represents the price that was able to prop up the price movements at points 1 and 2. But this support turns into resistance once the price falls below it, as illustrated by points 3 and 4. The opposite of this process occurs when the price breaks above resistance. As you can see on this chart, points 1 and 2 begin as price barriers. But once the bulls are able to push the price above the dotted line, it becomes an area of support. Using support and resistance. To use support and resistance effectively, we first need to understand how asset prices typically move, so we can then interpret support and resistance from that framework. There are also different types of support and resistance, such as minor and major or strong. We expect minor levels to be broken, while strong levels are more likely to hold and cause the price to move in the other direction. With this information, we can start making better decisions based on support and resistance. Trading ideas, breakouts. One of the best ways to improve your trading skills is to see what others are doing. Trading ideas can be predictions, market analysis, or trade setups based on concrete market conditions. With the play button, you can see how predictions actually played out. Ideas can also contain educational material and show how trading methods, analysis approaches, or tools exactly work. There are many areas of technical analysis. Some are basic, others are more sophisticated, and all are supported with intelligent drawing tools. Many bar styles, lots of data, and a host of indicators. Trading ideas can relate to any asset class, like currencies, stocks, or futures, or any trading method, like harmonic patterns, wave analysis, or chart patterns. Often traders use a combination of several methods and look for confluence and increase their odds. There are also ideas on risk management, trading psychology, and trading plans. Regardless of the method you use, it's indisputable that the cycle of creating, sharing, collaborating, and learning based on well thought out ideas will help you improve your trading skills. Therefore, trading ideas are your research and preparation for the next trading day and will be visible on the daily chart. Warning: do not enter a trade without having a clear trading idea. Why do breakouts occur? A breakout is a price movement of a security through an identified level of resistance, which is usually followed by heavy volume and an increased amount of volatility. Traders buy the underlying asset when the price breaks above a level of resistance, or when it breaks below a level of support. This chart shows a stock that has historically encountered resistance near $37 over a 6-month period, followed by a subsequent breakout approximately 5 months from the last time the resistance level was tested. In practice, a breakout is most commonly used to refer to a situation in which the price breaks above a level of resistance and moves higher. Once a resistance level is broken, it often becomes the next level of support, when the asset experiences a pullback. Most traders use chart patterns and other technical tools, such as trend lines, to identify possible resistance price points that are likely to experience breakouts. Similar price movements to the downside are more often referred to as breakdowns. Breakouts manifest more often in market conditions where potential upward price movement is expected. For example, when the market is range-bound and price actions approaching the upper end of the range, savvy traders prepare for a price breakout above the upper range resistance level. Technical chart patterns such as head and shoulder, triangles, and flags that are near completion in their formation and signify upward price movements are also common spots for breakouts. Once price action makes a final movement to confirm the pattern, a price breakout usually follows. Significant news events may also cause price breakouts. These breakouts are more unpredictable and depend on the effects that the news has on a particular security.